I'm not sure where we were there last time. So you want me to start from tenure of loan, Rupal, or repayment? I was there actually.
Tenure of loan is...
Hello?
Yeah, you can start from tenure. Hello?
Yeah.
please
So, okay, thanks. I heard you. Yeah, I mean, as I was talking to you about the tenure of loan, this is one of the important things which needs to be negotiated in terms of that has got a critical impact on the cash flows and the profitability as such. So most of the times it is dependent on the project cash flows, and it could vary from 3 to 15 years, which includes the moratorium period also. These are the requirements of the banks and financial institutions. So, but how banks stipulate the tenure based on internal and external ratings of the borrower. So the typical AAA to A rated external rated borrowers, it is up to 15 years for large infrastructure companies. And again, AA to BBB rated companies, it could be anywhere between 10 to 13 years for again large infrastructure companies. And any other companies B rated and above up to 7 years. And for any C rated or below, it could be 5 years. It does not mean they will get the loan, so it is subject to various other parameters on which bank evaluate, if at all they are providing the sanction. Right. Now the impact of that would be like, most of the companies fall between A and B, and their repayments will be about 5 to 7 years. So the reason is some of the companies which are stressed also because of the rating, if they insist that we should have about 5 to 7, it will impact the cash flows. Shorter tenure loans will have strained cash flows for any new projects. So now the way to go about in terms of negotiation, so we always negotiate for slightly longer tenure as it would ease cash flows in the initial stages of new borrowers or new business or new companies. And for existing companies, we have to estimate future cash flows derived from the investments made through new capex. Then it should be segregated from their existing business and the new business on standalone basis, how it is going to match. So out of the curiosity, company managements may say that, okay, we have enough cash, so we will be able to repay that within short term, which should not be the case. And what we have to say is in terms of how much is this new division is going to be cash positive when, and then what will be the repayment capability if you built in the repayment schedule into the model. So again, additional collaterals for new companies is the one thing which we have to talk about to the banks for faster negotiation on this point. Again, then TR and escrow accounts to mitigate the risk of default for longer tenure. So if he insists for a new company for longer tenure, they may not give. Again, if they give, again, there will be a stress case. So obviously we have to ask for longer tenure that can be negotiated by means of offering a TRA or escrow accounts. Now, as far as the repayment schedule is concerned, now after deciding about the tenure, then most important point is how do we schedule the repayments. This is generally banks give in terms of straight line method over a period of loan period. And so normally what happens on a straight line basis, so they will estimate and then they will try to find out, yes, this works out, but in reality it may not be. Basically there will be a lot of strain on the cash flows. So if you, whatever this repayment schedule and the cash flows, for some reason they are not able to achieve their projected sales or the profitability, then there will be a lot of issues. So that is why we need to always look into the practical way of looking into the projected cash flows. So, and then arrive at a structured repayment schedule rather than actually having a straight lining. Of course, most of the banks also are open for structured repayments these days. But what happens normally is, even if they say, okay, we are okay for the balloon repayment or bullet repayment, but the terms in which a balloon repayment is structured, that they will consider the fact in terms of how much percentage of repayment should be done in the initial period and during the mid period of the loan term. it will be accelerated, and then again it tapers down, and at the near end it will be zero. So those percentages of something we have to negotiate. And bullet repayment is not for all, and generally it is for a company which has got a high reputation, and for such AAA rated companies, the bullet repayment is possible. And in some cases, when the projects are really good and they feel that it can be mitigated with the support of other securities or other loan, the other guarantees, then they can still look at bullet repayment, but it is normally not for all. So this also depends on the seasonality of the business and projected cash flows. So the repayment schedule is to be decided at the time of appraisal, and then it is before they actually give the sanction, then the whole repayment schedule will be ready. So when they give the final sanction, then they will also draw up a repayment schedule in the sanction. That will also go into the loan documents. Right, and now next important term would be prepayment charges. Now this is one very most important thing these days. In the initial slides, I told that there is a active takeover and refinance market. So this is one term which can actually spoil the show. So prepayment charges are built into all the sanction letters and also the loan documents. The idea for the banks is to generally discourage prepayment so that they will have that returns what they have initially thought about from a client. So that is why they expressly make sure that there is a prepayment charges, and that could range up to 150 basis points or more. So of course, if you are prepaying, that also calls for some penalties and additional charges. So this has to be carefully viewed in terms of what are the charges which are built into the my loan sanction. So this will impact, say, after 2-3 years of running this loan with one bank, and suddenly the markets have improved and interest rates have come down, and I want to take advantage of that situation. This prepayment charges should not come in the way, so that is why it is important to check each of these terms very carefully and build into my total loan pricing or the cost of borrowing. So this can be a bottleneck for that. So that is required to be negotiated. So the borrower should negotiate to ensure that the loan documents state that the company may prepay the loan. So that clause is required, and also the fees at which that prepayment is agreed should also be discussed upfront, and then that should be negotiated. And these are mostly negotiable across the table, and most of the banks before the final sanction and disbursement, they will be talking to us because they will give us a draft terms and conditions. So based on that, we will go out to the board, and then we can talk to them. These are the things at which we will be able to go forward. So these are negotiable, and at times it can go down to even 50% and below 50% also. So this requires not much of a this thing, because it is after appraising everything, it is only a cost. So that point of time, we will not have to worry too much about how do we negotiate with them. It is across the table that can be done. Now, most important thing is one of the all the loan agreements and finance sanctions of the banks, they will incorporate some financial covenants, which could be protective covenants or negative covenants as well. So some of them are financial covenants in order to ensure that the companies perform as per their initial discussions and as per their initial application they made to the bank, that they will adhere to certain parameters or the indicators what they promised, and the key things like DSCR, DER, CER, and also they will incorporate a few other things such as the total debt by EBITDA should be less than 4, or whatever they are comfortable. It depends on the bank to bank. And again, most of them will stipulate the condition of getting external credit rating, and it should be at a minimum investment grade. Now, minimum investment grade, they may define whether it is BB or BBB or whatever, A. So it depends on the bank to bank, and also the company to company, they can decide. So the idea behind this is to make sure the companies adhere to the projected performance indicators as given in their loan application, and that's how they sanction the loan, so that they want to ensure that their repayment is prompt and surely they get it back. Now, breach, say, while the businesses are not sure, while we are doing business, so the conditions and whatever assumptions we thought about may not be exactly same, and there is every chance every company will breach the financial covenants at least once in their entire loan tenure. So it is possible that they will break. So obviously when they break, banks levy heavy penalties in the form of penal interest and seek additional collaterals or any other requirements they may stipulate. So these are all heavy because this can alter the complete profitability of the company. These are very critical. Now additional collaterals I may or may not have, then I may have to borrow something, and if they insist on stipulate a penal interest that was never accounted in all my projections and profitability statements, so that is going to be generally penal interest would be around 2% for most of the banks. So that is going to cost the company dearly. So that will alter the complete plans. So bank in many cases, if they find there is a problem in terms of slipping in these financial covenants, they may recall the loan. This will put the borrower in dire financial distress. So there are dangers of having the financial covenants without our understanding. So this definitely calls for a negotiation. Now, the most important thing here is to, when the appraisal is going on at the credit officers level and the company borrower's finance head have to sit together and they have to go through each and every assumptions properly and make sure that what projections we are giving. So it's all a balancing act is required. Now in the hurry of getting the loan, so we give certain projections. So those projections are built into the financial covenants. So it is like chicken or egg first. So basically we need to be balancing, and where required, we need to give convincing replies or the answers to the bank officials to reduce the covenants which we feel are not really able to meet up. So this, once a damage is done, then always there is a finance person running around and doing a kind of a damage control, which can be best avoided. So the appraisal point, the people who are going to sit with the bank officials and talk about that and also review the calculations vis-a-vis the actuals if it is an existing company and try to get the projections right. And that is the way we can avoid the damage, if at all, if it happens. So it is a worst case scenario I'm taking and then trying to see that we should negotiate to be safer in the future. Right. Now securities. Securities, when we are talking in there, it is primary securities any bank would insist. Normally the two types of securities bank would insist. One is securities which is primary for the assets for which they are financing. And second one is the additional security, we call them as a collateral. Now we are talking about the primary securities. In all the loans, what we have mentioned on the top, TL, OD, STL, CC, ECB, BD, LAP and BC. So these are applicable. Now having said that, now a bank, say it is financing a security, a plant and machinery or whatever, it's like, construction of building and everything. That becomes a primary security. So there cannot be any negotiation here. So when we are talking about terms which are negotiation, why this point is here, but it requires a special mention about it. See, while negotiating the total financing amount, so obviously then that is the time we have to see what are the type of amount I am getting a finance from the bank. And why this is critical is basically every bank on a continuing basis, they will check the FACR, that is a fixed asset coverage ratio. They always wanted to see it should be more than 1. Now what happens if the fixed asset coverage ratio is something which you are all aware? I can just give a brief on that. It is about the book value of the fixed assets divided by the outstanding of the loan. So what happens now, basically when I'm saying about the book value of the assets, so it gets depreciated, and then at some point of time, if I'm taking a higher amount of loan, so then it should not be appearing less than 1. So this is possible because there is a change on the depreciations now. So earlier it was a straight line method we could have gone through, but now based on the useful life, then depreciation is decided for each of the thing. So that should be mindful when we are going about in terms of discussion with the loan amount. So in case wherever there is a FACR is less than 1, then they will ask for more margin, or they will ask for collateral, or they will ask for faster repayment of certain amount. So these things will be called for. So we have to be cognizant of this. Now let's see about the collaterals. Now, as I just mentioned, collaterals are in addition to the primary securities. Now it could be both in the form of movable or immovable assets. So this would be asked in all of these loans, what we talked: TLOD, STL, CC, ECB, BD, LAP and BC. Now the lender determines his collateral requirement in addition to the promises depending on the various risks involved. Now the nature and the value of the collateral must satisfy lender's credit policies. Now it is like each bank has its own policy within the stipulated framework what suggested by the Reserve Bank of India. Now it will be minimum of 50% of the loan value. Depending on the risk profile, they may ask for higher, or they can restrict to 50%. Now promoters may not have the stipulated collaterals and hence may not be able to fulfill the requirements for disbursement. That is one thing. And second thing, in order to get the collaterals, what they do is they also go to a third party, which is not coming free. So what they do is they also buy the collateral, and that one thing they will also indirectly built into the company's financials. So that is going to be one more pain area, because their objective is to get the loan that time. They are trying to meet the requirements of the bank. So it is very important to go to the bank or the lender, and whichever bank is able to listen to our requirement, that is the way we will look at it in terms of collateral requirement satisfaction. Now reduction of percentage of collateral requirement can be done on based on basically it is on the project strengths and credit rating and group standing. These are the critical things, and of course without saying past financials and future projections when I said the financials. So yeah, and banks may accept the reduction of the collateral, but what happens is they will also alter some of the other terms, like interest rate can be high or reduction in the loan amount and etc. So that they will try to fit in the other parameters within the framework. So they will try to reduce the risk there, and by covering a higher, lesser collateral here by taking more interest. So it is actually we are trying to build a price for that. So that is one thing. And the lender's collateral requirement usually are not flexible once given in the sanction letter. So it is very important I negotiate with them at the time of appraisal and also before the final sanction is rolled out. So in a bank, what happens is it has become a accountability now. Somebody is saying it is okay, 100% of collateral required, and then even if I try to convince them later, no other officer or the official in the bank would like to reduce it because it becomes accountability, and tomorrow account becoming a kind of a doubtful asset, then they are responsible and they make them accountable. So these days it is very important to do everything upfront, so that once a rolled out sanction is there, then we can just close it for documentation and disbursement. Right, and the mortgage. Now once all these are done, then obviously when it goes the stage of mortgage, so basically the banks would mostly they insist for equitable mortgage, and also in some cases they ask for a registered mortgage of securities and collaterals. So as we all know, equitable mortgage will cost less, while registered mortgage attracts stamp duty and registration. We should be having a negotiation on that. Now this also based on the account value and past track record and strength of the company creditworthiness, one has to really convince the bank to go for a equitable mortgage, because that is going to save a lot. And even that amount also one can negotiate in terms of having a staggered payment if it is slightly higher than say 50,000 or above. So they are okay for negotiation in this, depending on these key parameters. They would definitely like to consider if you are able to convince them. Right. And next thing in the process, the terms are DSRA. As you are aware, DSRA is about debt service reserve amount. So which is insisted for various loans such as unsecured loan or LAP or term loans by the banks and financial institutions. So this is for basically long-term infrastructure projects they insist, or they find that there is a issue in terms of funds flow is not consistent, or they have a doubt in terms of management, how they're managing the cash flow, and they feel that there will be issue in terms of default which can happen in terms of servicing their principal or interest. So they may insist, and also with as I said, it is a weak DSCR or a tangible security is not in place. So DSRA will be normally a 3 months installment of both the principal and interest. So what happens is, this is a huge amount, so this can block the working capital amount. So of course they give a interest on that, but that is very nothing compared to the amount available to free my cash flows. So which definitely has to be negotiated with the banks and institutions, and the way we can look at is lower the tenure of the loan. DSRA is generally not insisted. Longer the tenure, they feel there will be a potential problem. And again, additional collaterals will help here. And more importantly, we can showcase the experience of promoter in the same line of business. That gives the banks a comfort, because he understands the business, and then he knows the cash flows, how it is going, and he will be able to repay on time. And again, the bank's experience with the group or the company is very critical to have this say towards borrower, because the bank relationship is what which matters most of the time in terms of negotiating some of the terms. So for new projects, one can negotiate to provide DSRA once cash generation starts. So we don't say we don't give it. Once the cash generation starts for a new project, we can negotiate and say that, yes, we will start the DSRA maybe after 6 months or 1 year, whenever the cash generation is positive, and then we'll do. That also banks will accept. Right? Yeah. And finally, this is something TRA, I'm sure most of you know, trust and retention account, and or escrow account, both would mean the same. And these are mostly looked by TL, ECB, LAP, or unsecured loans. Again, these are insisted for long-term projects such as infrastructure, and then they would normally insist and little in terms of waiver on that. But again, it causes two issues. One is operational inconvenience, and other blockage of funds and working capital impact. And again, to the extent of debt service amount. So operational inconvenience, if you, and most of you are aware, like escrow account or TRA, the way it works is they open a separate account, and the operation of that account has got a kind of waterfall mechanism. So they define the rules, which are the accounts, the amounts should, who should be paid, when they should be paid, and how it should be paid. So it becomes a little difficult for the companies to manage their businesses as it is earlier decided. So it will be very problematic, and most of the cases there have been issues wherever this escrow account has been operating. So what we can do in this is negotiate for waiver first on the grounds that past payment record is good and no default in earlier repayments. And second is the company group standing. And if they still do not agree, then waiver of escrow. Then what we normally do is we should ask for terms of escrow operations to enable smooth running of business. So what I can do is, okay, we will not have a kind of a each order wise, then I will have 2-3 buckets, and then I will say, okay, by 7th of this month, this amount has to go to this account, or from there we will be. So those things, they are flexible, and then for the purpose of meeting their escrow account, and then they are going to have kind of a lien on their amount which are reserved for their debt and interest, that can be held, and the balance amount can be transferred. So those are the things we have to negotiate with the bankers.
Abhiram?
Right.
Yeah, sorry for disturbing, but we also need to have some time left for question and answers.
I'm done.
Yeah.
Just 2 minutes, I'm done, sure. And then we'll take the question.
I wanted to just remind on that. Also, I would like to just say, if anybody has a question, you may just raise and put it up to us. So once the session is over, we will be trying to question those to Abhiram. Yeah, Abhiram, over to you.
Right. Thanks, Rupal. Yeah. I mean, these are the main things which is required to be looked at in terms of the standard terms in the banking loans. Apart from that, we also have other standard terms which are non-negotiable, but they are important to know. That's why I brought that here, like personal guarantees of the promoters, adequate insurance cover for both current and fixed assets, periodic submission of stock statements, timely submission of annual audited financial statements, and monthly, quarterly, half-yearly MIS. Annual inspection by bank officials, annual external rating to be submitted on time. These are not negotiable. So, but of course, they are also standard terms. That's the reason I thought we should be talking about that. Now, finally, we come to the almost end, key points for effective negotiations. The key thing is the relationship of the borrower and the bank is the key for having any kind of a good negotiations and better terms. Now, any person from the finance going into bank, he should be fully prepared in terms of the complete information about the project and the financials, company and everything. When he talks to the credit officer, his preparedness will give him so much comfort. Then later on, everything is again, it's only a discussion. So to do that, one is preparedness. Okay, when he asks this information, I give him on time without delay and promptly. And second thing is the conviction of the finance officer who is dealing with the banks from the borrower company. So conviction is something, when he talks about something, he should not wink, and the answer should be on spot and with a lot of confidence, and that will give enough confidence to the banker. Most importantly, the patience and perseverance which is required to deal with the banks so that my negotiation terms will be effective. Because banks do not work as per our timelines or as we require. So they work in their timelines and within their policies. So we have to understand that, and however demanding may be the company owner, but this is something we have to manage with the bank. Finally, at the end, we can't negotiate all the loan terms. We should focus to negotiate top 3-5 terms which are most critical for the success of project. Please remember, it's give some, take some. I hope you all understand, right? I think that's the everything about the terms and negotiations. I leave it for the Q&A now. Rupal?
Abhiram, Venkat here. There are some of us who are logged in together from the Chembur office. So we have actually emailed those questions to your email ID. So there are 3 or 4 questions there. So maybe you could just take that up as a start.
Okay, one is your mail I'm seeing, right? Is it a good idea to negotiate with two? Yeah, actually, I have noted down. I missed that point. The way it is actually, that is the main thing. Now it is very tricky. What happens is, first of all, we have to identify the right bank for that company. Because when I say right bank, it is like, we have to make sure that, each company has a different profile. So some of the owners or the promoters are not really comfortable with private banks, and some of them are not comfortable with the PSUs. So, but having comfort is something, but are they going to meet the requirements of the company? That is important. So it could be a mix and match. And second thing is, once we identify the banks, it is important to always go to 2-3 banks to have a better negotiation of all the terms. So always it is important to reach to 2-3 banks parallelly. That is one. And second is, will banks lend if promoters have no collateral to offer? That is absolutely no. And these days there is a high risk in the market. Even if the collateral is there, they are insisting for higher percentage of collateral. So most of the time it is no. And not only banks, NBFCs also will not be in a position to help. So third thing is, what is the concept of non-fund based limits? Can you give some example of non-fund based facilities? Yeah, I mean, I discussed this. One of the thing is the letter of credit and also the bank guarantees. These are the non-fund based facilities which normally bankers will also give as part of the working capital. Now, apart from that, they also give in terms of standby letter of credit, that is also a derivative of the LC. And again, these two are basically the non-fund based limits. As I mentioned during that, margin money, it was specifically discussed. So this non-fund based or something which are required for all the manufacturing companies and other things, which are not required for most of these service companies and trading companies. They depend solely on and infrastructure companies depend on non-fund based facilities. So these non-fund based facilities in isolation, cannot be given. They always link it with the fund based working capital also. So if I have to take limits on LC and BG, they also link it with my CC or OD, because there is a higher risk for the bank if they give only non-fund, and as per the RBI also, they cannot just give the standalone non-fund based limits. Right, and fourth one is if financial performance at end of financial year is not up to the mark, can the bank reduce its limit or insist on faster repayment of agreed installments? Can the bank reduce limits or insist on? Right, now what happens actually on year, every company are supposed to submit them something called the, as I mentioned in the standard other terms, they are supposed to send the financial statements. So even quarterly, half yearly and annually. So it is not normally at the end of the year. Of course, by that time, the banks will also know how the company is performing. They would have taken a call. So they would not even wait till year end to increase the limit or anything. They may find if there is a problem in the company, even before it becomes an NPA, if at all they have a suspicion. And in terms of company not doing well, they will immediately reduce the limits, especially they reduce the limit in the working capital. But in most cases, what happens by that time, all the limits get exhausted and companies use completely, including non-fund limits turn into a fund-based again. That means they are almost in a problem. So there is a potential this thing if the performance is coming down, and then they will reduce the limits also. And they will ask for a faster repayment. If that is not coming through, they will ask for a additional margins into the company by means of promoter equity, or asking for a equity infusion into the company. So this is what it is.
Okay,
Any other questions here?
Yeah, actually, Meera, Tanuja, if you're hearing in, we just got to see your questions very briefly. But for some reason we're not able to see it anymore. So would you mind emailing those questions to Abhiram and also putting it up again on the raise of hands in the webcam? If you can do both, that will be great.
I haven't got the mail yet.
Okay, so I can just see the question now. I'm able to retrieve it. The first question is from Tanuja.
Okay.
Can you throw some light on arrangements like bill discounting for EOUs, like one-time processing charges, rate of interest, etc.?
EOUs.
Yeah. Can you throw light on bill discounting for EOUs, EC, BC, etc., like one-time processing charges, rate of interest, and so on?
Yeah, right. Actually, see, bill discounting facilities will be part of the working capital sanction, whatever banks are giving. And when they are giving a limits comprehensively, only then they can go for the bill discounting. Now, bill discounting is again different from each of the banks, and the rates also vary from bank to bank. So again, which requires to be negotiated. Now, the kind of a client we have and kind of what type of bills we are going to discount. Is it the purchase bill or a supply bill? I mean the sales bill. So it depends on that, and who is the end, the customer or the vendor. So it depends on so many things. So they will go for appraisal and they will normally decide. So immediately we can't say that these are the rates and these are the commission charges, and they are actually very negotiable. That's what it is.
Does it mean that if it's an EOU, it is likely to be cheaper, Abhiram?
New?
Just because it's an EOU, one make an assumption that it is likely to be cheaper for a EOU as compared to a DTA unit?
I don't think that is that way, because EOU is only they are sending 100% export oriented unit, right? Whatever the rates applicable for a export, say there is a 100% export oriented unit, need not be, even if I am not 100% export oriented unit, I am just exporting some products. So the same rates will apply, and say for example, there are certain concession, I can tell you here. Okay, now if we say EOU in say some segment, diamond and jewelry and some of the key segments and which category they are following, government has also given certain concessions, like for bill discounting they will be getting a interest subvention also. So we have to see where exactly they are falling, and then they will get an advantage. So we need to see which industry they are falling and which country they are supplying and things like that, and that's what it decides,
Okay, we got one question from Meera Balkrishnan. The question is that if the borrower has breached certain covenants in the agreement with the bank, but if the company continues to pay the EMIs on time, will the bank still levy a penalty, or will there be a prior discussion with the borrower?
Right. They will not immediately levy a penalty, but definitely there will be a discussion with the borrower. But having said that, what type and what quantum the breach has happened, because the bank officials will be responsible if they are not collecting that penalties. So that is where the issue comes. Like, if the financial covenants, if I'm saying that, total debt by EBITDA should be less than 4, but it is say 6, 7, no way they can escape and they have to pay it. So even if they are paying the EMIs. So this is not anything with the operations of the company with the bank. It is again financial discipline. That is what, and every aspect of that will be reviewed in the credit monitoring cell in the bank. So they will ask the people, if you find that there is a relationship manager, they will come and sit with you to understand what went wrong, and then they will be under pressure to make you this payment. So normally it depends on the degree. Say if it is 4, but it is about 4.3, then if you are, they will seek an explanation from you and then they can close it out. But it depends on the degree to which you are breaching it.
Okay, so we don't seem to have any other questions, Abhiram. So possibly we'll bring the session to an end now. So thank you very much, Abhiram, for your time.
There is something. Deepak has sent one mail. 1 minute.
Okay.
Is it better to take ECB or FCNR? What is better? How does it compare in terms of cost as compared to an INR loan? Yeah, I mean, there is no question of any comparison with INR loan. ECB and FCNR are the cheapest forms of the loan. And if we are getting it, we should go for foreign currency loans, no doubt about it. Even if I take kind of a forward contract and also, try to hedge it, still it is much cheaper than the INR loans. So we should go for that. And now the question of ECB, it is not eligible for all, and because it is restrictive, and also in terms of certain companies are allowed and certain companies are not allowed, and purpose is also mentioned. FCNR loan is given to most of the companies with operating in India, because this is foreign currency non-resident portion loan from the India only. So ECB is you are borrowing from a foreign bank from abroad. So that has a different norms, and this has got a different facility. So obviously, if first order is FCNR and then go to ECB if they are eligible, and then anytime they are better than the rupee loan.
Okay, thanks. Okay.
Yeah, any other question?
There's one more question that's come from Narayan. The question is, will the bank provide funding for debtors discounting for all debtors outstanding, or are there any criteria?
Debtors, yes. That is what we talked about in terms of the bill discounting also, right? So when the debtors are there, obviously we are going. Most of the banks are comfortable to discount of the debtors, those who are got some good standing. So they will not try to discount each and every bill. So the discounting also happening, then it is definitely much better. But they are very careful in terms of discounting. Now, apart from the discounting, now the kind of we have a working capital called the CC limits. So obviously those are meant for meeting these requirements only. Now when they are giving a CC, the banks are going to talk about the drawing powers. Based on that, any company can withdraw the money for the purpose. Now drawing power also is got several rules how they will set a drawing power. They will not be talking about in terms of giving 100% of the CC to any customer. So they will set a limit like, what is the drawing power is about inventory and the debtors together. They will decide that. Now even the debtors cannot be more than 50% of the CC limits if they are setting a DP. So obviously there are other things also which is worked out in the market is factoring. So factoring, I mean, they can go to any factor and try to get those things discounted. Again, they will have a different set of rules in terms of how they will do, and they will screen all the bills and the vendor, I mean all the customers, and then they will say what they will discount and what they will not and what cost. So there are options. Of course, factoring has started, but not in a big way as thought about it. Yeah. And if it is some exports and other things, obviously there are different facilities like forfeiting and other things that can be looked at. Yeah, I have one more question from Mitesh. What will be the model to raise a working capital funds in SaaS business? They don't have stock or debtors as primary security. Yeah, there is some unfortunate thing. Now, whenever we are talking about IT, I'm talking about Mitesh question here. SaaS business is something which they don't have debtors, but obviously they will not get the CC there. But we can always talk to them about the overdrafts. So overdrafts are not linked necessarily with the debtors or the stocks. So overdrafts are something which works similar to a CC, but it is a working capital. So obviously that will be not unsecured, it will be SOD, that is secured ODs they will give. So one can definitely go to a bank and ask for a SOD. And if that is one thing, or they can still try to look for options in terms of having any unsecured loans, if they have. I hope that answers Mitesh's question. Yeah.
Okay, Abhiram, guys, I think we have completely run out of time, and we'll have to bring this very interesting session to a close. I think it's after a long time that we have had a solid technical session. So thanks, Abhiram, for having put together